Hello, Business 630. This is Professor Hassey, and this is our final lecture video for this Business 630 class for this fall session, week number 8, December 13th through the 29th. And a lot of things going on this week. You're finishing up your electrics case, which is due on Sunday. In addition to that is case number 4, which includes the topic of our discussion this week, number 8, alternative capital strategies. Our remaining week this week, we'll have a Thursday student hours for any questions or concerns that you may have. And then we'll have a wrap-up course video on Friday, December 17th to wrap up the class and get everybody prepared for grading and finishing up our course. So this cold and dreary day here in Claremont, and we're beginning our final coursework, and we're talking about leasing. So talk about the subject at hand for this week, number 8 is chapter 19 about leasing. And I'm sure a lot of you have experience with leases in your life, maybe leasing an automobile, leasing a copier or a computer, or I'm sure a lot of you have had experience in renting an apartment. That's a lease. If you can't afford to purchase a home, what do you usually do? You rent an apartment or rent a home. And that's what leasing is all about. It gives the individual a chance to acquire and use a physical fixed asset at a different way of paying for it. Naturally, as you all know, when you rent an apartment or you rent a car, you do not own that car. You can operate it, you can pay for the gasoline and the insurance and the maintenance, but you do not own the automobile. You cannot depreciate it. You cannot write it off on your taxes. It's owned by somebody else, and you're given the ability to use that asset by paying the lease. And that's very important, especially for small businesses. There's a great question in case number 4 this week. It asks about what's the advantage of leasing for small businesses? Well, the main advantages is you can use an asset that you might not be able to afford. One of the traits of a small business is they don't have much cash or they don't have much credit to be able to use to buy assets. So leasing is the alternative. I want to show you a little discounted cash flow analysis about leasing. Again, I'm not asking you to do this analysis in the case, but it's a good way of showing how effective leasing is. But before we get to that, remember, there's basically 2 types of leases. There's an operating lease and there's a financial lease. Operating leases are usually short-term, like leasing a copier or a computer, or even an automobile, leasing it for, maybe 2, 3, 4, 5 years. That's an operating lease, short-term. And usually the maintenance, like for a copier, is included. But if you rent or lease an automobile, you have to pay for the maintenance. It depends on the setup, but that's how it usually happens. A financial lease is a long-term obligation, like leasing a building, or like leasing office space with a contract that lasts 5, 10 years. There you definitely are responsible for the maintenance, but it's a different form of lease because you're paying for like square footage, you're paying for the revenue that's being generated off that space, and the lease it gets a portion of that revenue. It's a little bit different setup, but operating lease and financial leases are the 2 main types of leasing from chapter 19. Here's a spreadsheet that shows an example of leasing, and I wanted to show it to you because at some point in time, some of you are going to own properties or lease out properties, and this can be very advantageous to know about this, and also within businesses. What's the advantage of leasing something or purchasing something? And it talks about the key components of lease versus ownership. In this example, there's an asset of $1.5 million. And we have an option of leasing the asset for $400,000 a year for 4 years, or purchasing the asset by taking out a $1.5 million loan at an interest rate of 15%. And the thing about this loan, it's a non-amortized loan, meaning you pay interest only until the 4th year when the note is due, and then you pay the entire principal of $1.5 million. Naturally, loans are set up different ways, but if you qualify, a non-amortized lease is the way to go because it lets you generate cash flow off the asset and its use in the early years. You generate that cash flow and then you can pay off the maturity or the principal at the end of the option. Also, as you can see here, with a loan, you're paying interest only. The option of generating cash flow from the purchase of an asset, you pay out interest. In the case, 15% of $1.5 million is $225,000 a year. Then in year 4, you pay the last year of interest plus the principal of $1.5 million. So you're paying out these payments of roughly $2.4 million over the course of the 4 years of this purchase. But then you get a couple of tax deductions. Since you're borrowing this money, the interest is of $225,000. Part of that is deductible on your taxes. And notice I'm adding that back in as cash flow. 40%, which is our tax rate in this problem, of $225,000 is $90,000 a year. So we generate additional cash flow by borrowing money because we're getting a tax break. Also, we generate cash flow by depreciation. All right, this company is using the MACRS method of depreciating a 4-year asset. Here are the percentages over the life of the asset. There's the depreciation schedule. But if I take 40% of that depreciation, that's my tax saving every year because depreciation is a non-cash expense. I can write that off, and that's a write-off of taxes or a tax saving. So there's my depreciation savings. So as you can see, with the interest and the depreciation after taxes, you're generating $960,000 of cash flow by owning the asset. At the same time, there's residual value of that asset, scrap value. At the end of the asset's life, you can sell it or dispose of it or scrap it. And in this case, the example says we're going to get $250,000. Of scrap value or salvage value at the end of its life. Naturally, since we fully depreciated it over the 4 years, we have to pay tax on that gain. But all is said and done, besides the interest payments and the principal payments, we're generating substantial cash flow off this ownership of this asset. These are things you cannot take the advantage of when you're leasing. But since I'm owning it and paying an obligation, I'm generating positive cash flow in the first 2 years of this purchase. Then as my depreciation changes, I'm starting to lose, going to negative cash flow. And then naturally in the 4th year where I'm paying off the loan, I have a substantial amount of cash flow. But what this means is I now have this generated cash flow coming in and going out. If I take the net present value of that at my cost of capital, which in this case is 15%, I'm generating a negative $885,581 of actual cash outlay in present value. Excuse me, the present value is 9%. I'm sorry, 9%. That's the cost of capital, 9%. All right. If I leased this $1.5 million asset, instead of purchasing, I lease it, I'm going to have 4 years of $400,000 payments, of which a portion of that is deductible. All right, naturally, lease is an operating expense, which is deducted as a business expense. If my tax rate is 40%, then I'm only really paying out after taxes 60% of my lease. So I'm paying $240,000 a year. Notice no interest payments, no loan payments, and no depreciation payments because I do not own it. There's no residual value or after-tax gain. It's just the taxability of the lease payments. So if you take that $240,000 over 4 years and discount it back at the cost of capital of 9%, notice it's cheaper to lease this $1.5 million asset than it is to purchase. And that's called the net advantage to leasing. In other words, for an example like this one, when it's short-term financing at these interest rates and these tax rates, it's cheaper for me to lease instead of purchasing. And this is what's the advantages to small businesses, especially. It's going to be difficult for a business to get a $1.5 million loan. it's going to be difficult for them to pay out the cash flow in year 4 to do that. So what a lot of companies do, small businesses, they'll work out a lease arrangement, and usually it's cheaper for them. Now, if you go out longer term or get better interest rates on your financing, leasing might not be an alternative. But for small business, leasing definitely is an alternative, because the net advantage to leasing of the benefits that you see in lower payments, lower cash flow over the life, discounted back to today's dollars, shows you're saving about $108,000 in comparing these two things. And when you're an owner of a business or a manager of a department, many times you have to make the decision: should we purchase the asset to use, or should we lease? And an analysis like this would prove beneficial to determine that. But I think the key thing for our study and our discussion of case number 4 is the advantages for small businesses. They can fund and get the advantage of an asset that they could not afford by leasing. Yes, they lose out the tax advantages, but they're saving money in the long run because they don't have to pay back the debt. And that's a big thing for small businesses. So that's the advantage to leasing. And it's a way of generating capital. By leasing, you get the use of an asset when you don't have to purchase it, but it's an alternative capital strategy. Many small businesses fund the most of their business assets by leasing, because then they incorporate that lease into their cost analysis and pass that cost on to their customers, and they got it covered. The only disadvantage is no depreciation, no tax deductions. But for some small businesses, they would rather be able to use the asset to generate business, and that's a key. So leasing plays a part of the case study number 4, where we talk about and discuss alternative capital resources or other examples of capital resources. And the question number 1 involves, please explain why leasing as a capital financing alternative is an advantage to small business. And we just talked about that, and you can elaborate on that in your discussion. The second question is a little bit more pie in the sky, I guess you could say. If you were creating a business today, now, would you? Why or why not? What type of business would you choose, and how would you finance it? For a business startup, what would be your greatest fear and why? So if you could put yourself in the position of starting a business today or in the near future, would you or would you not? I think there's some advantages and disadvantages to both saying yes and no, but I'm anxious to hear your opinions on this topic. And second, and finally, mergers and acquisitions. Their discussion about mergers and acquisitions of a couple of weeks ago. I'd like you to pick the company that you selected back in week number 1 and go back in time 20 years to year 2000 coming forward. And did the company have any mergers or acquisitions in that time span? And if they did, give me these 4 different details of that in about 1 page of analysis. And did you, in your research on this acquisition or merger, was it, in your opinion, a success or failure? So this might take a little bit of research on your part, which I hope you do. And I'm anxious to see. All you have to do is write about a page, find the information. And I'm anxious to see. Now, I did a little research on this, and almost all the companies, I think, all the companies that you all have selected in this class have had some merger or acquisition during the last 21 years. So I think you'll be able to find that information and write about it in this question. And that's it. So as you complete your work this week, I want you to know that I'm available for any questions or concerns that you have, not only on Thursday's student hours, but anytime during the week. Feel free to send me an email, post it to the discussion forum. I'll be happy to answer any questions you all may have. I think one of the key things as we wrap up this course is to kind of summarize the overall strategies and overall things that we've learned. Naturally, a lot of us have learned how to use a capital budget analysis and trend and look at variable costs and fixed costs and cost of capital to determine the investment, but also the strategies and the decision makings that go into determining what type of capital we use in an investment of assets, and what type of alternatives do we have to raising capital. Instead of going out and borrowing money or raising stock, we could go out and merge or acquire or get capital from investors in the form of mergers and acquisitions, or we can find alternatives to capital like leasing. We also have developed and read articles about the strategies of looking at efficiency, of looking at how we measure things in our businesses. So I think the overall perspective of this class is to add to your resume of disciplines in your MBA study of what corporate finance is and what are the key elements of developing corporate finance: return on investment, maximizing values for your investors, able to be efficient in your strategy making about money and capital. I think these are all been key in this course, and this is what the case studies have tried to show in your analysis. So as we move forward to the end of this week and our final video on Friday, I want to recognize a couple of spots in your Blackboard that I need you to be familiar with. First of all, I have posted the evaluation link, depending on what CRN you are in this course, 1198 or 2949. You click on those links and you can do our course evaluations. For some of you may be new to the program. This is a new evaluation system that just started in the fall 1 session of this fall. It's different questions, more questions, a little bit more analysis. And I really would appreciate you to take a look at this evaluation and answer the questions. It helps me, it helps the school serve you better. And I think that's the most important thing. In addition, just to make sure you understand, our case study number 4 is posted, and there's the work there to finish up this week. Again, I listed some more evaluation links there, the same ones. And then as you conclude the electrics case this week, wrapping up that study and writing your paper. And many of you have given me your drafts of your spreadsheets, and it all has. Some of you have had a tough time with it, but most of you, or all of you, have gotten through it and managed it, figured it out, and now are able to write your papers. So I've been very impressed with this is not an easy case. This is an advanced finance case which requires a lot of thinking, a lot of figuring out interpretations, and then putting those interpretations in a spreadsheet and then writing about it. It's not easy, and I have had a lot of wonderful feedback from you all about your work and how you're going about doing this. So finish that up this week, and I look forward to reading those papers in the coming days. So I think that's about all for our lecture video for this week about alternative capital finances. There's that spreadsheet that I showed you in this video that's in the Blackboard in week 8. There's some articles about that, but at the same time, mainly, I want your interpretation of this alternative capital financing in your case number 4, and be able to wrap up our course. So until Friday with my final video, and maybe I'll see some of you in our student hours on Thursday night. Have a great week. Stay healthy, stay dry, and we'll see you down the road. Thanks, everybody. We'll see you later. Bye-bye.